What's up, crypto enthusiasts? Welcome back to Bonnie's Life, where we turn complex trading concepts into profitable opportunities. I'm Bonnie, and today we're diving deep into the world of cryptocurrency trading strategies, with a special focus on technical analysis, the trader's crystal ball in this digital gold rush. Whether you're just starting your crypto journey or you've been in the game for years, today's episode will equip you with powerful tools to navigate these volatile waters with confidence. Remember my trading mantra: charts don't lie, but they do speak in code. And today we're cracking that code together. Before we jump in, if you find value in decoding the crypto markets, make sure to hit that subscribe button and notification bell. Your support helps this channel grow. And trust me, your portfolio will thank you later. Now, let's talk strategy. The crypto market never sleeps, and neither should your analytical skills. Today's roadmap includes understanding the fundamentals, mastering key technical indicators, recognizing powerful chart patterns, and implementing risk management that keeps you in the game long term. As I always say, in the world of crypto, knowledge isn't just power, it's profit. So let's build that knowledge base together, shall we? Before we dive into the charts and indicators, let's make sure we're all speaking the same language. Even seasoned traders can benefit from revisiting the fundamentals. First things first, what exactly are we trading? Cryptocurrencies are digital assets built on blockchain technology, which is essentially a distributed ledger maintained by a network of computers. Bitcoin pioneered this space in 2009. But today we have thousands of cryptocurrencies, each with unique features and use cases. The crypto market has some distinct characteristics that set it apart from traditional markets. 1. It operates 24/7, 365 days a year. No closing bell here, folks. 2. Volatility is significantly higher than traditional markets. As I like to say, crypto doesn't walk, it jumps, runs, and occasionally skydives without a parachute. 3. It's influenced by a unique mix of technological developments, regulatory news, and market sentiment. Now, let's talk about market capitalization, which is the total value of a cryptocurrency. It's calculated by multiplying the current price by the circulating supply. Bitcoin and Ethereum dominate with the largest market caps, but don't ignore mid and small cap cryptocurrencies. They often present the greatest growth opportunities, albeit with higher risk. Volume is another critical metric. It tells you how much of a cryptocurrency has been traded in a given period. High volume during price movements suggests stronger trends, while low volume might indicate weak conviction. Remember my trading principle: volume precedes price. When volume spikes, pay attention. The price is likely to follow. Liquidity refers to how easily you can buy or sell an asset without causing significant price movement. Higher liquidity generally means lower slippage and better execution prices. Bitcoin and Ethereum markets are highly liquid, while some smaller altcoins can be quite illiquid, making them more susceptible to manipulation. Understanding these basics gives us the foundation to build our technical analysis skills upon. Think of it as learning the alphabet before writing poetry. Essential, but just the beginning of our journey. Now we're getting to the heart of our episode: technical analysis. This is where the magic happens, where patterns in price data become your trading edge. As I always say, the charts tell a story. Your job is to become a fluent reader. Technical analysis is based on 3 key assumptions. 1. Price discounts everything. All known information is reflected in the price. 2. Prices move in trends. Once established, trends are more likely to continue than reverse. 3. History tends to repeat itself. Market psychology leads to recognizable patterns. Let's break down the essential technical tools every crypto trader needs in their arsenal. Moving averages smooth out price action and help identify the direction of the trend. There are two main types. Simple moving average, SMA, calculates the average price over a specific period. For example, a 20-day SMA adds up the closing prices of the last 20 days and divides by 20. Exponential moving average, EMA, gives more weight to recent prices, making it more responsive to new information. Here's how I use them. When the price crosses above a moving average, it's potentially bullish. When it crosses below, it's potentially bearish. But the real power comes from using multiple time frames. I call this the moving average symphony. When short, medium, and long-term MAs align, the signal is much stronger. For example, look at Bitcoin's rally in early 2023. The 20 EMA crossed above the 50 EMA, which was above the 200 EMA, a perfect bullish alignment that preceded a significant price increase. The Relative Strength Index, or RSI, is one of my favorite indicators. It measures the speed and change of price movements on a scale from 0 to 100. Traditionally, above 70 indicates overbought conditions, potential sell signal. Below 30 indicates oversold conditions, potential buy signal. But here's a pro tip. In strong bull markets, the RSI can remain overbought for extended periods. In bear markets, it can stay oversold. That's why I never use RSI in isolation. Context is king. I look for RSI divergences when the price makes a new high, but the RSI doesn't. This divergence often signals a potential reversal. I call this the hidden truth pattern, because the indicator is revealing what the price is hiding. The moving average convergence divergence, MACD, consists of two lines, the MACD line and the signal line, plus a histogram showing their difference. And when the MACD line crosses above the signal line, it's a bullish signal. When it crosses below, it's bearish. The histogram helps visualize the strength of this momentum. What I love about MACD is how it combines trend and momentum in one indicator. During Ethereum's price action last year, the MACD gave several accurate signals that could have doubled your investment if followed correctly. Support and resistance levels are price areas where the market has historically reversed. Think of support as a floor. Buyers step in, and resistance as a ceiling. Sellers take control. These levels work because of market psychology and the tendency for history to repeat itself. When a support or resistance level breaks, it often becomes its opposite. Broken resistance becomes support, and vice versa. I identify these levels using previous highs and lows, round numbers, psychological levels, Fibonacci retracement levels. Remember my trading wisdom. The more times a level is tested, the weaker it becomes. A support level touched multiple times will eventually break, and when it does, the move can be dramatic. Chart patterns are the visual representation of market psychology. Let's look at a few powerful ones. Head and shoulders. A reversal pattern with 3 peaks, the middle one being the highest. When the neckline breaks, it signals a potential trend reversal. Double tops and bottoms. Another reversal pattern showing 2 peaks or troughs at approximately the same level. Bull and bear flags. Continuation patterns that look like flags on a pole, suggesting the previous trend will continue after a brief consolidation. Ascending and descending triangles. These patterns can predict breakouts with surprising accuracy. I spotted a textbook ascending triangle on Solana's chart last quarter, and those who recognized it had the opportunity to profit from a 40% move in just 2 weeks. What makes technical analysis so powerful in crypto is the market's high retail participation. More traders following the same indicators often creates self-fulfilling prophecies. As I like to remind my viewers, In crypto, technical analysis isn't just about predicting the future, it's about understanding the psychology of other traders. Theory is great, but application is where profits are made. Let's put everything together into a practical trading strategy that you can start using today. I call this my technical confluence strategy, where multiple technical signals align to create high-probability trading opportunities. First, choose which cryptocurrencies to focus on. I recommend starting with the top 10 to 20 by market cap for better liquidity and more reliable technical signals. For time frames, I use what I call the triple time frame approach. Higher time frame, daily or weekly for trend direction. Medium time frame, 4 hours or 1 hour for entry timing. Lower time frame, 15 minutes or 5 minutes for precise entry and exit points. Remember, the higher the time frame, the stronger the signal. A trend visible on the weekly chart is more significant than one on the 15-minute chart. Always trade with the trend when possible. Here's my method. 1. On the higher time frame, identify the overall trend using the 50 and 200 EMAs. 2. Look for the golden cross, 50 EMA crossing above 200 EMA for bullish trends. 3. Look for the death cross, 50 EMA crossing below 200 EMA for bearish trends. Let me show you a real example from Bitcoin's chart last quarter. When the 50 EMA crossed above the 200 EMA on the daily chart, it marked the beginning of a sustained uptrend that lasted for months. Those who recognized this signal early had multiple profitable entry opportunities. Once you've identified the trend, wait for confirmation before entering. I look for fourth price reaching a key support or resistance level. 5. RSI showing oversold conditions in an uptrend or overbought conditions in a downtrend. 6th, MACD showing momentum in the direction of the trade. 7. A recognizable chart pattern completing. The magic happens when these factors align, what I call a technical confluence zone. When 3 or more technical factors point to the same conclusion, the probability of a successful trade increases dramatically. For example, look at Ethereum's chart from March. We had price testing a major support level, RSI showing oversold conditions, MACD histogram beginning to shrink, suggesting a diminishing downside momentum, a double bottom pattern forming. This confluence created a perfect buying opportunity that resulted in a 25% price increase within 2 weeks. This is where risk management begins. Never, and I mean never, risk more than 1 to 2% of your trading capital on a single trade. As I always tell my viewers, it's not about being right. It's about staying in the game. For entry execution, I prefer using limit orders slightly below the market price in uptrends or above in downtrends to get better feels. If the market is particularly volatile, a market order might be necessary, but be aware of potential slippage. Your stop loss should be placed at a level that invalidates your technical analysis, typically below a significant support level for long positions or above resistance for shorts. For take profits, I use the tiered exit strategy. Take 1/3 of profits at a 1-to-1 risk-reward ratio. Take another 1/3 at a 2-to-1 risk-reward ratio. Let the final 1/3 run with a trailing stop to capture potential larger moves. This approach ensures you lock in profits while still giving your winners room to run. Remember my trading principle. Cut losses short, let winners run, but don't let winners turn into losers. Let's talk about something that separates successful traders from the rest. Risk management. In my years of trading, I've seen brilliant technical analysts go broke because they neglected this crucial aspect. As I often say, Technical analysis gets you in the trade, but risk management keeps you in the game. Never risk more than 1% of your total trading capital on a single trade. For those just starting, you might want to be even more conservative at 0.5%. Let me break this down with a simple example. If you have $10,000 in your trading account, you should risk no more than $100 on any single trade. This doesn't mean your position size is limited to $100. It means your potential loss is kept at $100. If you're buying Bitcoin at $50,000 with a stop loss at $49,000, a 2% drop, your position size would be $100 risk amount divided by $1,000 potential loss per coin equals 0.1 Bitcoin or $5,000. This approach ensures that even a string of losses won't significantly damage your capital. Remember my risk management mantra. It's not about how much you make when you're right, it's about how little you lose when you're wrong. For every trade, aim for a minimum risk-reward ratio of 1 to 2. This means if you're risking $100, your potential profit should be at least $200. With this approach, you can be wrong more than half the time and still be profitable overall. If you maintain a 1 to 2 risk-reward ratio, win 4 trades plus $800, and lose 6 trades minus $600 equals $200 profit. Even with a 40% win rate, you're still making money. This is why I tell my viewers, trading isn't about perfection, it's about probability and mathematics. Position sizing is how you translate your analysis into actual trades while respecting your risk parameters. Many traders get this wrong by 1. Using fixed position sizes regardless of volatility. 2. Increasing position size after losses to recover, a dangerous practice called martingale. 3. Not adjusting position size based on conviction level. Instead, use the formula position size equals risk amount divided by distance to stop loss. For more volatile assets or less certain setups, consider reducing your risk percentage even further. The hardest part of risk management isn't understanding it, it's implementing it consistently. The crypto market's volatility can trigger powerful emotions. Fear of missing out, FOMO, can tempt you to enter without proper analysis. Fear of loss can cause premature exits. Revenge trading after a loss can lead to oversized positions. This is why I've developed what I call the emotional circuit breaker. When you feel strong emotions influencing your trading decisions, step away from the charts for at least an hour. The market will still be there when you return with a clearer mind. Remember, the market doesn't care about your feelings, your bills, or your dreams. It only responds to supply and demand. Now that we understand technical analysis and risk management, let's talk about portfolio management, how to structure your crypto holdings for optimal performance. As I like to say, a well-structured portfolio is your shield against market chaos. Diversification means spreading your capital across different cryptocurrencies to reduce risk. But there's a fine line between diversification and over-diversification. My recommendation? 40 to 60% in large-cap cryptocurrencies, Bitcoin, Ethereum, 20 to 40% in mid-cap established projects, 10 to 20% in carefully selected small-cap projects with high potential. This structure gives you stability while still exposing you to potentially higher returns from smaller projects. I call this the pyramid portfolio structure, solid foundation with calculated risk at the top. Unlike traditional markets, cryptocurrencies tend to be highly correlated, especially during market downturns. When Bitcoin drops sharply, almost everything follows. To mitigate this, consider including stable coins for capital preservation during downtrends, but projects with unique value propositions that might show independence from Bitcoin's movements. Tokens from different sectors, DeFi, NFTs, layer ones, etc. I monitor correlation coefficients between my holdings and adjust accordingly. Remember my diversification principle. True diversification isn't about quantity, it's about uncorrelated quality. Markets change, and your portfolio should adapt. Rebalancing means periodically adjusting your holdings back to your target allocations. For example, if your target is 50% Bitcoin and 50% Ethereum, but after a price movement, it becomes 60% Bitcoin and 40% Ethereum, rebalancing would involve selling some Bitcoin to buy Ethereum. I recommend quarterly rebalancing for most traders, but also consider rebalancing when any single position grows to more than 20% above its target allocation. Market conditions change significantly. Your investment thesis for a particular asset changes. Rebalancing has two major benefits. One, it naturally enforces buy low, sell high. Two, it prevents any single position from dominating your portfolio. Leverage can amplify both gains and losses. While it's tempting to use high leverage to maximize returns, it's also the fastest way to blow up your account. If you do use leverage, start extremely small, 1 to 2 times maximum for beginners. Reduce your position size proportionally. Be even more strict with stop losses. Never use maximum leverage available. As I always warn my viewers, leverage is like fire, a useful tool in skilled hands, but disastrous when mishandled. We've covered a lot of ground today, from the fundamentals of crypto trading to technical analysis, practical application, risk management, and portfolio construction. Let's bring it all together. Remember that successful crypto trading isn't about getting rich overnight. It's about consistent application of sound principles, continuous learning, and disciplined execution. As I always tell my community, crypto wealth isn't built in a day, it's built one good decision at a time. The technical analysis tools we've discussed today, moving averages, RSI, MACD, support and resistance levels, and chart patterns, are your map in the often chaotic crypto landscape. But like any map, they're only useful if you know how to read them and have the discipline to follow where they lead. Risk management and proper position sizing are your shields against the market's volatility. No matter how confident you are in a trade, always remember that the market can be irrational longer than you can remain solvent. That's why we never risk more than 1% on a single trade and always maintain favorable risk-reward ratios. Portfolio management ensures that you're not just winning battles but winning the war. Diversification, correlation awareness, and regular rebalancing keep your crypto assets aligned with your long-term goals. Now, I want to hear from you. What technical indicators do you find most reliable? How do you manage risk in your trading? Share your thoughts in the comments below. I personally read and respond to as many as I can. If you found value in today's episode, remember to hit that like button, subscribe to Bonnie's Life, and turn on notifications so you never miss our weekly crypto insights. And if you're serious about leveling up your trading game, check out our comprehensive crypto trading course, link in the description. Until next time, remember my final trading wisdom. The market gives and takes away, but knowledge only grows. This is Bonnie, signing off. Happy trading, and may your candles always be green.